Hello, welcome to our eSignal Forex and Futures forecast. My name is Jay Norris. I'm a trading instructor at Trading University. As always, we need to remind you that trading is a risky endeavor and not suitable for all investors. First market we're going to take a look at today is the Australian dollar. Here's the Australian US dollar on a daily chart. We talked about this last week where at the time you had a potential double bottom. We talked about the very real possibility of a hiccup and higher prices, and that's what you got here. You did have a hiccup. You had higher prices. That little rally, however, was short-lived. We said overall that the downside target is going to be 85 down here, and then eventually we think even as far as 80, and that holds. You had a poor Australian employment number midweek that really knocked the Aussie down, and you actually took out the summer low. So we see that as a real positive for bears. That definitely reinforces our thesis that we're selling rallies on all time frames in the Australian dollar. Next market we'll take a look at is the Swiss franc. This would be the dollar Swiss we're looking at. So effectively, you're looking at a dollar chart. Really, when you see strength in this chart, that means the dollar is strengthening the US dollar. If we pan out to a weekly chart, you can see this market found good support right around that 382 retracement. So we are using the 382 to 50% as a buy zone in that case. You never quite got fully into that zone. You bottomed out on a 382. We think this is a pretty positive chart right now. Here's the daily chart. We're definitely advocating buying dips here and really buying dips on all time frames because you're really looking at a potential breakout in the making here, and this could possibly be a big one. We'd have to go all the way out to a monthly chart to get scale here. There it is. You can see the potential for that move is great. A lot of room on the upside. So, we think that this is a market that they'll go after that 2013 high. They'll go after that 2012 high eventually, probably sooner rather than later. This is a monthly chart, by the way. When you drop down to a weekly chart, you start to scroll down. You can see, there's some pretty good room on the upside. We definitely like being long currently. You want to add on dips. And we'll get into more of that, the dollar rally that this chart speaks of. But dollar Swiss, great looking chart. We think you'll see lower prices in the Swiss, much lower prices longer term here, to the advantage of the US dollar, to the advantage of the greenback. So Swissy, we like that on the upside. And here's your daily chart, gives you pretty good scale too. You can see why we like buying dips here. Next market is the dollar index itself. The dollar index could make strange bedfellows here on this up move, on this rally. Once it gets going in earnest, we'll have to see, and we'll cover that for you. Looking good, no matter how you slice it. The dollar index is looking pretty good. Here's the daily chart, a little bit shorter term. This is the big level you have to look to get through. If they can get through those November highs, I think you really take off here. That's the big level. We still like buying dips, and we like buying dips on all time frames, long-term and short-term time frames. Pan out to weekly so you can see where it's coming from. Now, for us, this is a great market to be looking for buy signals in. Why? Because the primary trend is up. This primary trend, if you go back a couple of years now, few years, the pattern's bullish. It has higher highs and higher lows. So primary pattern is bullish here. You love taking a shorter term change of direction, such as we're seeing now. You love seeing an intermediate term bullish shift here because it's in line with that primary pattern overall. So this could be a big deal for us. We like the US dollar. The November high here, as I go down to the daily chart, that's going to be the level to watch. We think if you get through there, you're going to see some acceleration on the upside, and that's going to be exciting. So US dollar looking good, and it may have some strange bedfellows there, and we'll get to that when we cover the commodities, because the commodities are valued in US dollars. Let's cover the euro first. If we like the dollar on the upside, then we don't like the euro on the upside. We like the euro, in fact, on the downside. Big support here, potentially at 135. It's just a number, though. We'll have to see how price reacts to it. Here's an interesting trend line for you. Usually when a trend line breaks, we anticipate a counter trend line move, and we look to get long again in line with the trend. It's a trend line breaks, you anticipate counter trend line move. Now, when longer term trend line breaks, you have the potential for a trend shift. We think realistically that we're looking at a potential sea change shift here in the euro. I took this as a sell signal here. and I was hoping for more of a rally here to get short. Didn't get it. Had to pull a Bill Williams here. I had to put a stop just below that low today to get me short if it took that low out, and it did. So add it to shorts there. Still wouldn't mind a rally to sell into, but I don't want to outsmart myself and miss a move. So I definitely add it to my shorts here when it made a lower low today. So Euro, pretty bearish overall. We think there's plenty of room down below. We think you do more than just test this low, the summer of 2013 low. If you go out to a weekly chart, we think you're going to test the summer of 2012 low all the way back here. So that's a long way below. So that's over 1,500 pips below, 15 full points lower. We think overall that you have a shot at covering that ground throughout 2014. Next market, the gold market. Now this is interesting. You ask most economists and even many traders what would happen if the dollar strengthens to gold. They'll tell you gold will weaken. Well, this is a weekly chart, and gold certainly didn't weaken. Did it? Let me go to a daily chart, and you'll actually see on a day when you had a runaway rally you had a pretty good rally in the gold market too. Guess what though? Gold is priced in US dollars. Gold actually increasing in dollar terms today. So insult to injury if you're anticipating lower gold prices based on a strong dollar, you didn't get them. Gold not doing so well as far as being priced in Swiss franc or euro. On the other hand, gold's doing pretty well when you look at it in dollar terms. So this will be something to watch. What's most interesting about this, going into a strong dollar environment, you've got to go all the way back to the end of the Clinton administration, the beginning of George W. Bush's administration, to find a strong dollar environment. And back then it was completely different. You had a lot less regulation. I guess we can say Wall Street wasn't so bridled in as they are now. Particularly the last couple of years, they've really roped in Wall Street. Primary dealers and the big banks, they've got back to being banks. They're a lot less speculative. And that's it was that speculation that got everyone in trouble in 07 and 08. And that ushered in the QE era where you saw government intervention, and really without the government, who knows what would have happened there. So that's why I say this strong dollar environment we're entering into is really the first time in modern economic times that we're going into a strong dollar environment. So it's going to be interesting. It's definitely a different environment altogether now than it was at the end of the Clinton administration, the beginning of the Bush administration. It was kind of the Wild West there. Wall Street pretty much got away with whatever they wanted. That's not the case anymore. You don't have a former Goldman Sachs president in Treasury anymore. So we'll see how that plans out. But I think maybe that starts to go a little bit along the ways of explaining how you could have a strong gold market and a strong dollar simultaneously. But gold is priced in US dollars. So it's going to be interesting to see the new relationships we see in a strong dollar environment. Next market we're going to cover corn. We covered this last week, and I said, hey, I like dollar cost averaging corn at these levels. Hey, I like buying corn on the approach to $4. You almost got there, but I think you could start dollar cost averaging corn. You can do it in the ETF too. It wasn't that long ago where you didn't have corn in ETF. You had to try it with futures. Futures, of course, are leveraged. Futures are dangerous because of that. Now you get in an ETF, you can buy corn. You can buy it $100 a month, $50 a month, as much as you want. So I think it's a good time to accumulate corn. Corn's also an energy play too, because there's your ethanol supply. So I like corn. When you look at corn from a historic perspective, going all the way out to a monthly chart, there it is. I like the idea of buying the old ceiling in corn. The old ceiling used to be $3.50, $4 a bushel. All that came to an end in the second half of the last decade, but now you're seeing corn a little bit more reasonable prices. But people have to eat, and they don't make any more land, right? So like corn overall, I think you start to dollar cost average it at these levels. Next market, crude oil. Into the commodities. Staying in the commodities here. Here's crude. That's a daily chart. We think overall that you're going to test this 89 level there. Let me pan out to a weekly. That's pretty good support right now. Kind of reminds me of the Euro chart over the last couple of years. We think similar. You're going to see lower prices. There's a lot more crude coming out of the ground than there ever has been in the history of the globe. You're seeing a lot more of that coming out of the ground in North America in particular. The U.S. is now energy independent. The U.S. moving towards being a net exporter. So energy is not a problem any longer in supply and demand dictating market prices. We think eventually that you're going to see crude oil chip away at that 89 level, break this long-term trend line, and we'll see price explore lower long term. That's very beneficial for the globe too. So, don't think that governments don't realize that and want to see that overall. Next market we're going to cover would be the 10-year note. And here's another one that, if you would have asked an economist what would have happened if you had a strong dollar, they'd say, well, that would probably be because you're having higher interest rates. That would mean the treasuries are going down. Treasuries actually stabilized here. Now, this is a weekly chart, but if you look at the treasury market, it's been trading higher the past 2 weeks in the face of a strengthening dollar. Again, that's that kind of strange bedfellows. We're in a strong dollar environment, and we haven't been there in modern times. So, it'll be one where we'll have to continue to monitor the relationships between the markets, the correlations in the markets. Hey, correlations change for sure. Markets are like people. Eventually they mature and friends come and go, and that's the same thing with correlations in markets too. The correlations come and go. So it'll be an interesting one for sure, this new strong dollar environment we're in, and we'll cover that for you. Hey, thank you so much. Always good to see you guys. My name is Jay Norris. I teach at Trading University, and we'll catch you next time. Thank you.